narratives are clean, and liquidity feels abundant. And most investors believe they are being paid to stay optimistic. But taking a look at the Bank of America bull and bear indicator, that is not bullish. The Bank of America bull and bear indicator has just surged to 8.5. That is not bullish. That is not neutral. That is not constructive. That is not constructive consolidation. This is a sell signal. Historically, when this indicator reaches these levels, future returns compress. Volatility rises and downside risk overwhelm upside reward. So this is not an opinion. Okay. This is a positioning math. Let's take a look at it. And today, I'm going to explain why this signal matters more now than ever any prior cycle. So what do I mean? Well, the bull and bear indicator is not sentiment service. It's not vibes. It is not a Twitter optimism. It is flow-based, positioning-based, systematic capital behavior. It aggregates 6 core components. 1, hedge fund positioning. 2, equity fund flows. 3, bond fund flows. 4, credit market technicals. Global equity breadth. And 6, fund manager survey positioning. So at 0 to 2, markets are washed out. At 8 to 10, markets are crowded, extended, and fragile. At 8.5, risk is asymmetrically negative. So why is 8.5, and you could see the little arrow pointing to the red, right? On the left. Why is 8.5 a problem? And don't forget to subscribe to this channel and to join my Patreon channel, because I do provide information that is important to you, but more important, that I am looking at the risk embedded in the market from different perspectives. In this particular case, we're looking at, what does Bank of America think, it's bull and bear indicator and what it means to you. That is important. That is what you want to get in order for you to avoid losing money in the market. We're not so much trying to make money here. We're trying to not lose any, because that is where the talent is, and that is what no one is focusing on. So this tells us something critical. There is no marginal buyers left. So at 8.5, the equity flows are in the 94th percentile. Global equity breadth is at above 80%. Fund managers are heavily allocated to risk. And credit markets are complacent, and volatility premiums are compressed, as you could see in the charts. This tells us something critical. When everyone is positioning long, there is no one left to buy. Markets do not crash because of bad news. They crash because of crowding. And this is extreme crowding right now, meaning everybody wants to get out at the same time, or everybody wants to get on in the same time. That is never a good place to be. Why? So basically, from an historical track record perspective, look at history. 2007, 2011, 2018, 2021, 2023. Forward returns decline sharply. Drawdowns increase. Volatility spikes, and correlation converge to 1. Importantly, this indicator does not time tops perfectly. And it's absolutely destroyed the risk-adjusted return when ignored. At 8.5, the probability distribution shifts violently against you. This is where risk management matters more than upside fantasy. Right now in the market, everyone is telling you, let me tell you what you should be buying. Let me follow the Pelosi list of names and what is Warren Buffett doing, what he's not doing, right? They're all focusing you on the upside fantasy that you make market by buying low and selling high. You make money. You don't make money by buying low and selling high over the long term. You make money by avoiding losing any. So that's why it's called risk management. Matters more than upside fantasy. This is what this channel is about. This channel is about looking for the next potential black swan, this thing that is going to destroy the market. So why is this cycle more dangerous? Well, this cycle is not normal. This cycle is not normal. It is not. Liquidity is being mispriced. 2, deficits are exploding. 3, rates are structurally higher. 4, debt services costs are rising. We owe $37 trillion in the US. And rates are not about to drop anytime soon. Forget what the Fed is doing. The Fed is just applying to the rate of the Fed fund rates. I'm talking Treasury rates. And that's not going any lower, which it should by now, but it's not, because they're expecting inflation. Risk assets are priced as if A, volatility is gone, growth is guaranteed, central banks are backstopping everything. This is the illusion of stability. Crowded positioning plus structural macro stress equal nonlinear downside, meaning, boom. When positioning unwinds, it does not unwind gently. And don't forget to take a look at some of the other videos that I have on commodity and silver. We'll talk about silver and Bitcoin very shortly. Right? The fact is that everyone goes for the actual physical assets, no more paper assets, because they're building up. They know that thing is coming. That black swan is coming. So retail investors hear sell signal and think, sell everything. That's not the message. The message is asymmetric risk. At this level, upside is incremental, 1. 2, downside is convex. Hedging becomes cheap relative to risk. Could make money going long, going short the market right now with some long-dated put. Cash becomes an asset and patience becomes alpha. And don't forget to join the Patreon channel for more and detailed recommendation. Every morning, I shoot you a mail, a message telling you what I think is happening in the market and maybe some potential recommendations as well as to, what makes sense and what doesn't make sense right now. So this is not about fear. This is about math and how professionals respond to this signal. Professionals do not panic. They reduce growth exposure, tighten stop structures, rotate away from crowded trades, right? In Bitcoin, increase optionality, and raise liquidity buffers. This is capital preservation season, not hero season. Again, be careful. Watch your backside. The best investors survive cycles by avoiding forced selling. So either you sell when nobody else is selling, or you start hedging your portfolio, so when everybody is selling and everyone is selling, you're making money. At 8.5, the bull and bear indicator is not whispering. It is screaming. Crowding is extreme. Complacency is embedded. And the margin for error is rather thin. Markets punish consensus, not caution. The question is not whether this indicator has ever been wrong. The question is, can you afford to ignore it when positioning is this stretched? That's the next one. I like this chart. This should be very interesting. Let's talk about our second one here. This beautiful Christmas day. But we have to think about preserving our capital. We must think about understanding what's going on. That's very important. Join the Patreon channel every day. Every day. The same way I do this every day on the videos, I go into more details into my Patreon channels. I want to share my good fortune with you. So, let's begin. Gold is not about yield. I will explain. This is not a curiosity. This is not a footnote. This is not a coincidence. This is one of the most important signals of the last 25 years. Another one. And almost no one is talking about it. What am I referring to? Okay. Since the year 2000, central banks across the world have been quietly, methodically, and aggressively stockpiling gold. Since the year 2000, central banks across the world have been quietly stockpiling gold. That's what they've been doing. They've not been trading it. They haven't been speculating on it. Not timing it, just buying it. They're just buying it. And the countries leading these accumulations are telling us something profound about currency, geopolitics, debt, sanction, and the future of money itself. So this is a real story behind gold. What does the data actually shows? From 2000 to 2024, net addition to official gold reserves revealed a stunning hierarchy. At the very top, Russia with nearly 2,000 tons. China, almost 2,000 tons. Then there's India, Turkey, Poland, followed by a second tier. Kazakhstan, Saudi Arabia, Thailand, Mexico, Singapore. This is not random. This is policy. And the most important thing to notice is not who is buying gold, but who is not. Because gold is not about yield. Gold is not about growth. Gold is not about innovation. It is about survivability. Gold has no counterparty risk. It has no default risk, and it cannot be frozen with a keystroke. And since the early 2000s, three structural forces have converged. First, exploding sovereign debt. You can't deny that. Two, weaponization of currencies and payment systems. And the weaponization of the dollar, especially with the US versus Russia, for example. Third, the erosion of trust in fiat stability. You know, is the dollar strong enough? Are we losing the dollar? What about the euro? Gold is the anti-system hedge. It's a great hedge without getting into actual hedging through options and things of that nature. Central banks do not buy gold because they are bullish on commodities. They buy gold because they are bearish on the system itself. That is what you have to start thinking. I am not investing to make money. I am investing to avoid losing any. That is the ticket. That is how hedge funds operate. And that's how they're famous and make lots of money. Let's be blunt. This chart is dominated by Russia and China for a reason. Russia learned painfully that reserves held in foreign currency are not true reserves. They can be frozen. China understands something even more fundamental. You cannot challenge a dollar-centric world order while holding dollar-centric assets. You're holding the very thing that's making you dependable on them. Gold allows strategic autonomy. Gold allows monetary sovereignty, and gold allows insurance against sanctioned trade wars and financial fragmentation. This is not about replacing the dollar tomorrow. That's what they tell you. This is about reducing exposure to a system that is increasingly political. And don't forget to subscribe, give me some thumbs up, and join my Patreon channel. Definitely, to support this channel. So, what is the emerging market signal here? What is this thing trying to tell us? Well, notice something else. Many of the largest buyers are emerging or middle-income economies. These countries live closer to currency crisis, inflation shocks, and capital flight. They understand what developed economies have forgotten. That fiat regimes are fragile under stress. Gold is not there for prosperity. Not buying gold because I'm going to sell it. No. Gold is here for disorder. Start looking at it the other way. That is the reason why this channel was created. This channel was created, the Black Swan channel was created to look for exactly what is the market trying to tell us. And it's telling us right now, buy gold. Oh, okay, so I could make money. No, we're not here to make money from gold. We're to protect ourselves with gold. Right? Gold is here for disorder. When central banks that manage inflation, liquidity, financial stability choose gold over foreign bonds, they are making a statement. We trust metal more than promises. Right? I mean, so what does this mean for the dollar system? Well, this is not a sudden collapse story, right? This is a slow erosion story, and it's happening right in front of you. Gold accumulation does not kill the dollar overnight, right? It doesn't. But what it does is that it actually it weakens the margins of trust. It reduces reliance on U.S. Treasuries as the sole reserve anchor. That's what it does. And that's an important consideration, right? It creates optionality in a fractured world. What does that mean? Well, what else can I do? Stop thinking about gold as a way for you to make money. Think of gold as a way not to lose any. That's the idea of this channel. The dollar remains dominant, right? Obviously, but dominance is no longer unquestioned. Gold is the escape valve. Why retail investors are always last? Well, like you, right? Retail investors debate gold when prices move. Should I buy gold? Should I not buy gold? Is gold going to keep going up? Central banks accumulate gold when risks rise. That's what you should be doing. The only problem for you is, how do I measure risk? I could measure gain. I know if the stock goes from 10 to 20 or gold, goes up from 1,000 to 2,000, I could see it. So should I buy at 2,000? Should I buy at 2,500? One thing that you do not see, and they do not help you, is what is the level of risk in the system? And this is what this channel basically helps you, tell you, well, there's risk with, currencies, and there's risk with the dollar, and there's risk with the Fed and the interest rates and Bitcoin, right? The risk is everywhere. You got to see it to decide which one you need to worry about. And then, of course, the biggest risk of all is $37 trillion worth of debt. So retail investors debate gold when prices move. Okay? And central bank accumulate gold when risks rise. But by the time gold becomes obvious, the accumulation phase is already complete. This chart shows you 25 years of advanced positioning. The question is not, why is gold rising? The question is, why were central banks preparing decades in advance? So the message that you're supposed to miss, basically, is that gold is not being bought because of inflation prints. Because that's what you hear all the time, right? Inflation, the hedge. It is being bought because of systemic distrust. It's not about trades, it's about architecture. When central banks behave like this, they are telling you something quietly, that the world ahead will be less stable, more fragmented, and more political. And in that world, gold doesn't need to outperform. It just needs to be there. Okay? So hopefully this is helpful to you so that, Alex, so that you get to see and understand the world that you're living in. And it is a very, doesn't matter which country you're in. This world is becoming more complicated. We'll talk about Bitcoin in a few, but basically when you look at Bitcoin, you're saying, well, the hedge against, no, Bitcoin is in trouble right now. It never got above $100,000. And now it's losing ground. It has broken it with the NASDAQ. And take a look at some previous videos on that. And as far as gold is concerned, which is the topic of this conversation, gold is currently telling you that there is risk. And right now, and take a look at some previous videos, but basically whenever there's systemic risk in the system, people, investors, tend to move to actual physical holding of assets. Gold and silver is up 120%, by the way. And look what JP Morgan is doing. And copper is also up. Why? I mean, do we need it to make stuff? No. Because the paper assets, you could print them. It doesn't mean anything. We're having huge issues, not just in the US, but globally with currency, central currency, for central banks that are just printing money. It doesn't mean anything anymore. It still means something today. And I want you to start preparing yourself just in case it doesn't. How do I prepare yourself? Join my Patreon channel. I'll tell you exactly, some of the options that you could get into, some of the ETFs that you get into that involve in silver and gold, and I'll show you how they behave every day. It's a learning curve. It's not something that, tell me what to do and I'll do it. No. You need to, first of all, you need to understand what's happening. And what's happening is gold is going up because risk is going up. Let's talk about Bitcoin and silver. Okay. That one is a doozy. And I will explain what I mean by that. Okay, let's talk about this topic. This is silver and Bitcoin, right? So let me start by making a statement that will make a lot of you uncomfortable. This chart should not exist. On the top, you're looking at Bitcoin, obviously, the so-called hardest money of the digital age. And when we talk about Bitcoin, we're really talking about, all kind of cryptocurrencies, right? At the bottom, you are looking at silver, the most historically suppressed monetary metal on Earth. And yet, Bitcoin has broken its long-term uptrend. Silver is in a well-intact parabolic advance. Can you see that? One is breaking the line, the other one isn't. That alone should stop you cold. Because for the last decade, investors were told a very simple story. Bitcoin replaces gold because it's a hedge against inflation. Bitcoin replaced gold for the same reason. And Bitcoin absorbs all monetary demand. And markets don't care about narratives. Markets are care about liquidity, confidence, and trust. That's what you need. This whole thing is based on these three things. And this chart is screaming for something has changed. You know, what does this broken long-term uptrend really means? Let's be precise here. This is not a short-term pullback. This is not a weekly shakeout. This is not a healthy correction. Bitcoin has violated a multi-year trend line that defined its entire post-2022 recovery. Long-term uptrends are not arbitrary lines. They represent persistent capital commitment. When that line breaks, it means marginal buyers are exhausted. Liquidity is no longer expanding. Risk tolerance is declining, and reflexive upside momentum has failed. And most importantly, it means that Bitcoin is no longer leading. Every major bull market in Bitcoin history has shared one feature. Bitcoin leads first and everything else follows later. These are the type of views that I want you to get. I want you to start understanding. When I say you, I'm talking about subscribers. I'm talking about my members. I'm talking about my Patreon members as well, which there are many now. Every day, you guys want to hear from me. What do I think is happening? I'm not telling you, buy this or sell that. Not very often. What I tell you most of the time is be careful about this and be careful about that and protect yourself against this and protect yourself against that. When you want to cross the street, you want to make sure first you don't get run over. And right now, this is going to be a problem. Bitcoin is no longer leading. Every major bull market had Bitcoin led first. This time, Bitcoin broke first. So this is not bullish leadership. This is not a distribution behavior. This is a distribution. Why Bitcoin is losing momentum now? Right? That's a big question. What's going on? Well, ask yourself the real question. Why now? Why would Bitcoin lose momentum after ETFs, after institutional adoptions, and after regulatory clarity, right? This year, Bitcoin, say, and cryptocurrency, go to town, people. In the US, the coast is clear. Because those things don't matter as much as what people think. Bitcoin is not just a relief or a belief system. It's a liquidity-sensitive asset. And liquidity is tightening in ways most investors don't want to admit. One, real rates remain restrictive. Global dollar liquidity is fragmented. Treasury issuance is absorbing capital, and for risk premium are quietly rising. Bitcoin thrives in excess liquidity environments. Silver thrives in monetary stress environment. That is how you need to start looking at commodities, a stress indicator. And that difference explains everything you are seeing on the screen. Now look at the bottom panel, silver. no broken line, no loss of momentum, no structural failure. Instead, you see something rare, a well intact parabolic advance. This is not speculative froth behavior. This is not a monetary. This is a monetary repricing behavior. Silver does not move like this unless something deeper is happening. Historically, silver goes parabolic when confidence in fiat erodes, inflation proves sticky, monetary credibility weakens, hard assets demands broadens. Silver is not chasing narratives. Silver is responding to systemic stress. And unlike Bitcoin, silver does not need leverage, optimism, or digital rails to function. It simply exists. So the critical difference between Bitcoin and silver, and that no one wants to talk about, is that Bitcoin is a confidence-based asset. Silver is a necessity-based asset. Are you positive or negative? If you're positive, then go for Bitcoin. I don't see too many people doing that right now. That is what it's telling you. That's what the we can tell. Bitcoin is a confidence-based asset, while silver is a necessity-based asset. Bitcoins depends on continuous inflows, market confidence, functional liquidity plumbing, regulatory tolerance. Silver depends on industrial demand, monetary hedging, physical scarcity, global trust erosion. So in terms of expansion, Bitcoin outperforms, and in terms of stress, silver survives. And the market is clearly telling you which phase we are entering. So why is this a warning, not a coincidence, right? So let me be very clear. This divergence is not random. Whenever you see risk assets losing structure, hard assets gaining momentum, parabolic metals with broken crypto trends, it signals capital rotation, not growth. Capital is not leaving markets. It is changing its objectives from maximum upsides to minimum regret. This is the psychology behind silver's move, right? Not speculation, not hype, preservation. That's what's that. So what happens next if this continues? That's a big question. Well, volatility will expand. So if Bitcoin fails to reclaim this broken trend, volatility will expand. Confidence will fracture. Leverage will unwind. Narratives will collapse. Meanwhile, if silver maintains its parabolic slope, price discovery accelerates. Physical shortages intensify, and industrial demands competes with investment demand. The gold-silver ratio compresses violently. This is how monetary regime shifts begin, quietly, before the headlines, before the consensus. So the final message is this. This chart is not telling you to abandon Bitcoin. It's telling you something far more important. Bitcoin is no longer the only monetary signal. Silver is speaking, and when silver speaks loudly, it is because trust in the system is cracking. Broken up trends don't lie. Parabolic advances don't lie. The question is not whether Bitcoin will bounce. The question is, what is the market preparing for? Because right now, hard money is outperforming hard narratives, and that should make everyone pay attention. That is what I am trying to do for this channel. I am trying to explain to people that you need to start looking at it, not so much in terms of, how do I make money in the stock market? That's not what it's about. You're trying to decide, how do I not lose any? And the reason you have been, unfortunately, predisposed for that is because whenever you look at the news, Whenever you look at social media, the focus is on, bro, you're saying the most basic, obvious, go bet on gold gum. That's not the most obvious thing. That is not obvious to people. What's happening is people are looking at gold. They say buy gold because you could make money buying gold, or gold is a hedge against inflation. That is not what this is telling you. This is telling you that you need to buy gold and silver and copper to protect yourself as a hedge, as a risk monitoring device. No one thinks about it in terms of not losing any money. You're thinking about how am I going to make money? And what you don't realize is that this idea of making money in the stock market is based on the belief that somehow the stock market responds to news, that the stock market responds to earnings. It doesn't. Of course it does, you're going to tell me. I'm on Bloomberg all the time, and these people keep talking about stocks and prices, right? And right next to it, they're showing you the news. When you go on all these, even the Wall Street Journal and all these places, they're showing you returns because that's the only thing you understand. It's a lot easier for you to understand that a 10 is more than 5 because you know that, right? You just made 100%. What's wrong with that? There's nothing wrong with it. But what you need to understand is you need to understand the risk. Can you calculate the risk? I am sure and it's not just normies betting on AI bubble. Everyone angry on AI right now. Let's see gold drop when the bubble doesn't burst. You see, but you're still thinking in terms of it going up or down as a store of way of making money. Gold is now, and silver is now reacting. And the reason it's reacting like that, frankly, because who's doing the buying of gold and silver? It's not you. It's all the big players, the central banks, the JP Morgan. Why are they doing it? They're doing it because they know what's coming next, because they're in the thing. They know, the central banks know that they're not going to be able, or they know that other central banks are not going to be able to monitoring these things just by setting rates. Oh, what is the Fed going to do next? The Fed is going to lower the rates. Great, so rates going to be lower, it's going to be cheaper. Well, they could do whatever they want, but the treasury yield is still going up because the market knows that there's inflation in the system, and they also know there's risk in the system. The fact that the 10-year yield is still up tells you that they know there's risk in the system that is not being addressed. The risk we're talking about specifically is the risk of not being able to maintain and keep up with the payment on $37 trillion. What is Beyond saying? In 1962, 1 ounce of silver was $1, gas 35 cents. Today it's $70. Gas is lower than ever in real money. Well, that's oil. That's great, right? The only thing is, what you need to worry about is what's going to happen next. And I'm worried. I'm not worried to Monday morning. I'm worried by the end of next year, something is going to break. The signal, the signs are here. The signs, commodities are going up. 2, inflation is not under control. How do I know? You got caught in the mainstream of put your money in gold or you get cooked. Says who? The people, silver is holding the value for everything. Of course. Silver is holding its value because people are worrying about the fact that not so much that you need silver to make jewelry, is that you need something that has a store of value. You got to put your money somewhere. If you're Russia right now, do you really want to hold dollars? Do you know that right now Europe is going to take the $200 although they wanted to, but they won't be able to. They wanted to take the $200 billion from Russia money in Europe and give it to the Ukrainian, quote unquote. Right? That is not a good thing to do, because now you realize that paper asset, yes, put your cash or in real estate. The problem is you can't put it in cash because it loses its value over time. And inflation is going to be a thing, an ongoing thing. And how do I know that? Because the Fed is targeting 2.5% to 3%. They know that inflation is here to stay. Right? Real estate. Well, let me tell you about real estate, right? Sure. Collect real estate and collect rent. Do you know how much risk is in real estate? You know how much return is in real estate. Yeah, because you know when money comes in, money comes out, you're paying your tenant. I used to have, apartment buildings and everything else. The thing is, I realized that I did not know how to measure the risk. What is the risk in real estate? What is the risk that this person is not going to pay you? What is the risk that the house is going to break down and that the pipes are going to burst and that you're going to get sued by a tenant? What are the risks of all that? You have no idea, because no one tells you, and it's incalculable. You cannot know how much risk is in real estate. I agree that you know how much money is into real estate because you see people making quote unquote money, but you do not know how much money they are putting at risk. And because you don't know how much money is being put at risk, you're crossing the streets with your eyes closed. And that's what they did in 2008. I remember I was there. Right? When the whole thing collapsed, the system collapsed completely. So right now, the message that I have in this channel, and I want you to join, in particular the Patreon channel, to help support this channel, because we're looking for stuff, right? We're looking all the time, is that we want to know where the next black swan is going to come from. Black Swan from the book The Black Swan by Taleb Nassim. Taleb Nassim wrote this book about the black swan. You may not know who Taleb Nassim is, but he's a very good friend with Spitznagel, who owns a hedge fund called Universa. And Universa made 4,000% at the time of COVID. How did they make that kind of money? They made that kind of money by what people are doing right now with gold, by basically hedging themselves against the market by buying long-dated puts, by hedging the fat tail, right? Where you think you're not going to, like at the time of COVID, people were saying, well, they're not going to close the country, right? It's not like China, we're wearing masks all the time. Yeah, that's exactly what they're going to do. No way. The same way Michael Burry made a lot of money hedging against the portfolio, because he said that the housing, don't listen to me. Go watch the movie The Big Short. He hedged the housing market, saying it's going to collapse. And he made a huge amount of money. Right now, it's in my Patreon channel, but basically I went in and I said, look at this option, this S&P 500 option expiring in July of next year. Look how much money you could make, right? If basically what it is, if the market goes down 2%, the option goes up 10%. Right? Suppose the market goes down 10%. Your option could double to triple in price. Why? But because it bets against it. And the thing is, what it is, you're hedging yourself. You're hedging yourself against a potential downturn. You're not looking for the next NVIDIA, right? Maybe you find the next NVIDIA, but then you have to find a bunch of them over and over and over. And it's impossible to beat the market consistently. Okay? Portfolio managers, only 20% of them beat the market consistently. It's impossible. And they're professionals. Oh yeah, what chance do you have? But what you have to do, and we all know what it is, at least at this channel, we need to protect the risk. You need to make sure that I tell you, look right, look left before you cross the street. And then you cross the street. You don't just cross the street with the eyes closed, right? But don't. What happens if the market doesn't crash in a few years? Well, the market doesn't crash, right, before it's too high because it's too high. The market crashed because people lose confidence. Simple as that. And right now, I will tell you, and I think it's one of my previous videos, if you take a look at all of the other crashes that have occurred in the past, right? Look at all the other bull markets, including the last one was a .com, for example. We are currently, the NASDAQ 100 is tracking it very, very closely. But, I mean, it went off like that, and then it collapsed. Right now, we're probably like maybe almost halfway through. So we are mimicking previous bull markets, but we're nowhere near a crash per se. We're probably going to get there very soon by the end of the year, though. So you have time, and this is where this channel is important to you. You have time to kind of think about it, listen to what I say, believe it or not, and then start acting up on it. Because you need, I'm not saying to sell your portfolio. I'm not saying Monday morning we're going to crash. But if you look at silver, you look at the treasury rates, right? You look at the valuation, you're slowly getting to the point of no return. And once you get there, it's too late. And that's not the time to, well, I'm going to sell my stocks now. It's too late. You lost your money. What you want to do, because you don't want to do what Warren Buffett did, right? Because supposedly Warren Buffett's the best investors in the world. I don't think so. Because he unwound his positions last year in July. You say, oh, look, Warren Buffett is selling its positions. And look, he doesn't own, the market's going to crash. The market didn't go anywhere. Trump got elected and the market just took off. And it went down a bit in April and it took off again. So I don't think Warren Buffett is such a good investor because he lost a lot of money. Right? So I'm not telling you I know what's going to happen to the stock market. No one knows. And if somebody tells you that they know what's going to happen, good luck. It's like saying, yeah, you could cross the street, close your eyes and cross the street, you're going to be fine. And you close your eyes and you cross the street. What I'm telling you, look left and look right. I cannot ever guarantee you're going to get across the street, but if you look left and if you look right, chances are you have a fighting chance. Let's talk about rates. Let's talk about rates. With the 10-year yield. Now, follow me there, for it's not too complicated. Doesn't talk about some obvious stuff, but I think you need to understand what I'm about to tell you. So essentially what you have is, let me start by telling you something that investors still don't understand. The Federal Reserve cut rates do not automatically push long-term interest rates lower. It doesn't. Just because they lower quote-unquote rates doesn't mean no. In fact, historically, they often do the opposite. What you're looking at, right? What you're looking at is one of the most misunderstood dynamics. And in modern microeconomics, this is not a theory. This is not an opinion. This is empirical history. That's what this is. And what this is telling you is that what happens to the 10-year Treasury yield from the start of the Fed cutting cycle until the Fed has delivered 175 basis points of cuts. That's what's telling you. And what it reveals, follow me here, it's a little deep, but this is important. What it reveals is deeply uncomfortable for everyone positioned for a simple rates down, bonds up narrative. Because across multiple cycles in 1989, in 2000, in 2007, in 2019, the long-term end of the curve frequently rises, not falls. And now, in the 2024-2025 cycle, the signal is even louder. Okay, so to be clear, the chart you want to focus on, right, is the 2024-2025 cycles, which is the dark blue line on top. That thing is not going down, it's staying up. Right? That's kind of the problem right now. So what is this telling you? Let me explain to you. The chart measures, the horizontal line is time, basically. So this is time in business days leading up to the moment when the Fed reaches 175. The vertical is a change in the 10-year yield relative to the start of the cutting cycle. And you could see that the blue line doesn't change. It doesn't impact the 10-year treasury. Each line represents different historical Fed easing episodes. And the takeaway is striking. In most cycles, all of them, if you look at them, right, the 10-year yield does not collapse when the Fed starts cutting. In most cases, it rises meaningfully. That means long-term rates are not responding to policy rates. They are responding to something else. See the blue line? And that something else is inflation risk, fiscal credibility, the $37 trillion that you owe, and term premium. Most investors are caught in a simplified model. The Fed cuts the rates, the bond yields fall, and the equity rally and risk assets surge, right? This is simple. That model assumes one critical condition, and this is important. Don't tell anyone, but the bond market trusts the Fed, right? But that's not the case anymore. But when the trust weakens, when inflation risk remains elevated, when fiscal deficit explode, when debt issuance accelerates, the market rebel. That's what's happening. That black line above, that's what it is. Long-term yields stop following the Fed. They start pricing sovereign risk, not policy intent. Now, the reason this is important for you is because that blue line above, that's your mortgage. Because the 10-year yield is where they price your mortgage off, not the Fed fund rates. And that is exactly what this chart captures. Look, in 1989, the Fed cut aggressively, but the 10-year yield eventually rose as inflation concern resurfaced and growth expectations stabilized. Look at 2000. Rate cuts begin as a tech bubble burst, yet long-term yields remain stubborn, volatile, and uncooperative. Look at 2007. This is critical. The Fed was cutting into a financial crisis. Initially, long-term rates did not collapse. They moved erratically until the system finally broke. Markets often expect the end result without enduring the process. So some will point to 2019, to 2019. Yes. There was a period when long rates fell alongside cuts. But ask yourself, what was inflation in 2019? What was the deficit? What was the debt to GDP ratio? What was the supply of treasury? This was disinflationary world. Look at the black line, the one that we're concerned about, the 2024-2025 cycle. Despite expectation of easing, despite growth slowing, despite repeated calls for bond rally, the 10-year yield is higher. Why? Because this is not a normal cycle. Again, another warning sign. This is a cycle defined by structural inflation, by fiscal deficit, massive treasury issuance. That is what you are seeing. And that is disturbing. Deglobalization. The bond market is pricing reality. The real message of this chart is the following. This chart is not about interest rates. The same way gold is not about investment. It's about credibility. It tells you that the market believes a central bank is cutting from strength versus cutting from desperation. When the Fed cut rates, right, because inflation is conquered, long rate falls. But they don't think that inflation has been fought off. When the Fed cuts because something is breaking, long rates rise. And that distinction changes everything. If long rates stayed elevated, equity valuations compress. Duration become dangerous. Government borrowing costs rise and fiscal math deteriorates. So the most dangerous phrase in market is, historically, rates fall when the Fed cuts. That is not true. This chart proves that statement is incomplete at best. They are controlled by confidence, and confidence is being lost. And once confidence breaks, policy loses power. So this chart is a warning. It's not a recession, not of inflation alone, but a system where monetary authority and market reality are diverging. What if nothing ever happened and the gold prices starts falling? What do you think the normies will do? Not sell. What happened if AI will bring returns? What if downgrade was rating again, which is they'll downgrade the US? Yes, they will. The 10-year has nothing to do with the rate cuts. Well, hold on. We have many questions here. The 10-year, yeah, it has nothing to do with it in the sense that what the Fed does, it just cuts the rate on the Fed fund rate, which is how much money they borrow with each other, right? But it should impact the 10-year because the bond market, the traders should believe what the Fed is doing is right, and therefore they won't hold bonds because they don't expect higher yield later on because they don't expect inflation. But right now, what's happening is they believe that there is inflation in the system. That's why they want more yield. And therefore, it is impacted. What if they downgrade the U.S. rating again? Well, it is quite possible, quite frankly. And that's because, unfortunately, what's going to happen is we may have more yield problem. What if nothing ever happens? Well, something is going to happen. Something is going to happen because what's going to happen is people are talking about it. No problem, Christopher. They're going to downgrade at some point because you can't keep raising 37, 38, 39 trillion. What you need to do, what I want my Patreon channel to do, members, is protect yourself. Okay, protect yourself. Either save some money or either buy some gold, buy some silver, buy puts. I'm not saying to sell your portfolio. Just protect yourself. That's the last thing you could do.